April 21st, 2026. Washington, D.C. A man named Kevin Warsh sat before the United States Senate and was asked one question repeatedly in different ways. Are you going to be the president's human sock puppet? That was the actual phrase used by a Republican senator about the person nominated to run the most powerful financial institution on the planet. Warsh's answer, absolutely not. Here's why that exchange matters to you, even if you've never heard of Kevin Warsh, even if you've never thought about the Federal Reserve, even if you think this is just Washington politics. Every interest rate you've ever paid, every mortgage, every car loan, every credit card, every time inflation ate into your paycheck. All of it traces back to one institution and the question of whether it answers to data or to whoever won the last election. By the end of this video, you'll understand exactly why that question is more dangerous than it sounds, and what happens when the answer goes wrong. Before we get into what's happening right now, I need to tell you about the 1970s. Because the 1970s is the answer to every question this video is going to raise. In 1971, President Nixon was facing an election. The economy was slowing. He wanted it to grow. Faster growth meant better numbers. Better numbers meant more votes. So Nixon pressured his Fed chair, Arthur Burns, to keep interest rates low. Burns complied. Cheap money flooded the economy. Growth picked up. Nixon won in a landslide. And then the bill arrived. Inflation climbed through the 1970s and peaked at 14.8% in 1980. A decade after Nixon made the call, not 4%, not 6%, 14.8%. Groceries, housing, energy, everything. The purchasing power of ordinary Americans was destroyed, slowly, then all at once, by a decision made for political reasons 10 years earlier. The delay makes it invisible until it's too late. To stop it, the next Fed chair, Paul Volcker, had to raise interest rates to 20%. 20%. That caused a severe recession. Millions of jobs disappeared. The medicine cost more than the disease. Remember that number? 14.8%. We're coming back to it. There's a mismatch built into the center of this whole debate that most people never think about. A president runs on a 4-year cycle. Lower rates mean cheaper borrowing, faster growth, better headlines. The inflation that follows that decision usually shows up 18 months later, sometimes more. Long after the ribbon cutting. Often after the next election. The Fed is supposed to operate on a completely different timeline. Its decisions take over a year to fully work through the economy, which means the person setting rates today is actually managing consequences they won't be able to see yet. That gap between when a decision is made and when its full cost becomes visible is precisely why the Fed was designed to be independent. When you put that decision in the hands of someone who needs to win an election in November, you get Nixon, you get Arthur Burns. You get 14.8%. This isn't theory. Researchers have studied central bank independence across dozens of countries. The result is consistent enough to be uncomfortable. Economies where the central bank answers to politicians tend to have higher inflation, more volatility, and more frequent crises. The extreme version of this has a name: hyperinflation. And it has never, not once, in 250 years of documented cases, arrived without a government first taking control of its central bank. Weimar Germany, Zimbabwe, Venezuela. The details are different every time. The sequence isn't. Meet Eleanor. She doesn't follow monetary policy. She's never read a Fed statement in her life. What she does know is that her mortgage is high, her savings account earns almost nothing, and groceries cost noticeably more than they did 3 years ago. She doesn't connect any of those things to a building in Washington. Nobody ever explained that connection to her. Nobody explains it to most people. But she was watching that Senate hearing on her phone during lunch, half paying attention, half eating, when a Republican senator asked the Fed nominee if he was going to be the president's sock puppet. She didn't catch all the names. She didn't follow the procedural arguments. But she heard that question, and something in her registered. This isn't theater. This is a real thing being decided right now. She was right about that. The Federal Reserve was created in 1913 after a series of financial panics that nearly broke the banking system. Congress gave it a mandate: keep prices stable, keep people employed. And to do that, it was handed one primary tool: the ability to set interest rates, raise them, and borrowing gets expensive. Mortgages cost more. Businesses slow hiring. Spending drops. Inflation cools, but growth slows with it. Cut them, and money gets cheap. People borrow. Businesses expand. Spending picks up. Growth comes back, but prices can start climbing. It's a dial, not a switch. And every position involves a trade-off. What's unusual, what makes the Fed different from almost every other government institution, is the insulation built around the people who turn it. Fed governors serve 14-year terms. Not 4 years, not 6, 14. Long enough to span multiple presidents, multiple Congresses, multiple economic cycles. The whole point was to put the dial in the hands of someone who doesn't need to be re-elected. That structure held, more or less, for most of the last century. What's happening now is a stress test on whether it still does. Donald Trump has made no secret of what he wants: lower interest rates now. He said publicly that whoever he nominates as Fed chair will support cutting rates. He has criticized current Fed chair Jerome Powell, his own original appointee, more aggressively than any president since Nixon. And then he nominated Kevin Warsh. Warsh is not a random name. He served on the Fed's Board of Governors during the 2008 financial crisis. He knows this institution from the inside. For years, his position was hawkish, cautious about cutting rates, focused on inflation risk. Exactly the kind of Fed official who would resist political pressure. Then Trump nominated him, and Warsh began arguing that rates could come down without triggering inflation, citing AI productivity gains as the reason the Fed had more room to move. Democrats called it a flip-flop. Senator Elizabeth Warren said directly, "Trump wants the Fed to artificially juice the economy to solve his political problems." Warsh pushed back at the hearing. He said the president never asked him to commit to lower rates, and that even if he had, Warsh would have refused. You now understand why that answer carries so much weight. But here's the twist nobody expected. Warsh's confirmation isn't being blocked by Democrats. Republican Senator Thom Tillis announced he would hold up the vote until the Department of Justice drops its criminal investigation of current Fed Chair Jerome Powell. That investigation, opened by a Trump-appointed prosecutor, centers on cost overruns in a renovation of the Fed's headquarters. A federal court already blocked the subpoena of Powell. The prosecutor is appealing. Tillis called the investigation bogus. He said, "If we imprisoned everyone involved in government budget overruns, we'd need a penal colony the size of Texas." But he's still blocking the vote. The committee stands at 13 Republicans and 11 Democrats. One Republican dissent means the nomination fails. As of April 2026, Kevin Warsh cannot be confirmed. Jerome Powell's term ends in May 2026. The most powerful financial institution in the world is currently operating in a leadership vacuum created entirely by political maneuvering, and Eleanor's mortgage renewal is in 8 months. The Fed's interest rate sits at 4.25% to 4.5% as of April 2026. That number is not abstract. It's what your bank uses to calculate your mortgage rate. It's what determines how much you earn on savings. It's what sets the floor for the 22% your credit card charges you. It's one of the inputs in what the U.S. government pays to service $36 trillion in debt every single year. A 1% shift in that number moves trillions of dollars across millions of contracts simultaneously. Eleanor has a mortgage renewal coming in 8 months. She's trying to figure out whether to lock in now or wait and see if cuts come. That decision is genuinely impossible to make well right now. Not because she doesn't understand mortgages, because the answer depends on whether the next Fed chair cuts rates because the economic data says to, or because there's an election coming and the president needs the economy to look good. If it's the first, waiting probably makes sense. Rates come down when they should, her payment drops. If it's the second, inflation comes back. The mortgage payment shrinks nominally. Everything else gets more expensive to compensate. She's felt that before, even if she didn't have a name for it. Most people over 40 have, 14.8%. There's one more thing happening right now that almost nobody is connecting to this story. The Supreme Court is currently deciding whether the president can fire Federal Reserve governors for political reasons. The case involves Lisa Cook, a Fed governor Trump tried to remove over allegations two courts found unsubstantiated. The Supreme Court agreed to fast-track the case. Here's why it matters. Since the 1930s, Fed governors can only be removed for cause, meaning documented misconduct. That clause was written specifically to protect the Fed from exactly this kind of political removal. If the Supreme Court sides with Trump, that protection disappears. The president could, in theory, replace any Fed governor who votes the wrong way on rates. The 14-year terms that insulate monetary policy from election cycles become meaningless. The mechanism that separated the Fed from Nixon's playbook, gone. Whatever the court decides will set the boundaries of presidential power over the Federal Reserve for decades. That decision is coming this year. Back to Eleanor. She put her phone down after watching the hearing. She had a half-eaten sandwich and 8 minutes left on her break. She still doesn't know what the federal funds rate is. She still doesn't fully understand what the FOMC does. But she understood something. That room, those senators, that nominee, that question, was deciding something real. Something that would show up in her life without anyone ever calling her name. In her mortgage renewal, in the price of her weekly shop, in whether her savings account outpaces inflation or slowly loses to it. The Federal Reserve doesn't send you a letter when it changes your financial life. It just changes it. And the question of whether it changes your life based on economic data or political pressure is not settled. It's being settled right now. There's a practical question underneath all of this. If you have a mortgage renewal, a car loan decision, or any significant borrowing coming up in the next year, don't assume rates will move in any particular direction. Model what your payments look like if they stay flat. Model what they look like down 1%. Model up half a point. The range is wide right now. The honest answer is nobody knows, because the answer depends partly on politics, and politics is unpredictable by design. What you can control is your exposure to the uncertainty. If you're carrying credit card debt at 22%, waiting for the Fed to save you is the wrong strategy. That rate is not going to zero. Attack it now, regardless of what happens in Washington. The other thing, and this one matters more than it sounds, is knowing what to watch for when the Fed moves. A rate cut justified by slowing job growth and cooling inflation is a different thing than a rate cut announced 3 months before a midterm election, with inflation still running above target. Same headline. Different meaning, different consequences for your cost of living. You now have the context to tell them apart. In 1951, the Treasury and the Federal Reserve signed an agreement that gave the Fed back its independence. It took 9 years of political control, inflation the government couldn't stop, and an economy that had forgotten what stable prices felt like, before both sides agreed the arrangement wasn't working. It's called the Treasury-Fed Accord. Most people have never heard of it, but it's the reason the dollar held its value for most of the last 7 decades. Right now, in April 2026, that accord is being tested harder than at any point since it was signed. There's a nominee who changed his position on rates after the president who wants lower rates chose him. There's a Supreme Court case that could strip Fed governors of the legal protection that makes their independence real. And there's a president who has been more openly aggressive about bending the Fed to his preferences than anyone in office since Nixon. Any one of those things on its own would be a story. All three happening at once is something else. Eleanor doesn't know those names, but she knows something costs more than it used to. She knows her savings aren't keeping up. She knows the question in that hearing room was real, even if she couldn't fully explain why. The Federal Reserve is not abstract. It's the institution that decides how expensive it is to borrow money in America. And right now, someone is deciding who decides that.